Hey guys, welcome to Mentorship Monday. Thank you for watching and thank you for submitting your questions. We've gotten so many questions lately to helpme@DeRosaGroup.com, the email address you have to submit your questions on. For the next couple weeks, I'm going to be doing multiple questions so you guys don't have to wait weeks and weeks to get your questions answered. So thank you for submitting the questions, and for those of you guys watching, you're going to benefit from a couple of different questions and a couple of answers coming from different sides of the real estate business coming at you. So thank you guys for submitting and thank you for watching as well. Don't forget, helpme@DeRosaGroup.com is where you want to submit your questions to Mentorship Monday. So here we go. Today's first question is coming from Josh from Atlanta, Georgia. Josh is getting into the real estate business and he's looking at a bundle of properties. This is a couple of single-family homes he's purchasing as a package. Josh is looking at 5 deals. He's saying they're high equity, cash flowing rental houses. That probably means that he's got a lot of value gap in what he's buying them for versus what they're actually worth. Sounds like he's got a great deal. I have 20% down payment, but most lenders I've approached require a bank statement, and I'm worried because I don't have much activity in that account. Sure, they're going to ask for a bank statement. They're going to ask for your personal and your business bank accounts. They're going to ask for a credit report and everything like that. Any typical bank lender is going to. It sounds like you also have good credit. You've said here elsewhere in the email. Don't worry about the activity you have on the account. Just go ahead and show it to them. Unless you've got something you're trying to hide, show them everything you got. Show them the bank statements. Show them your personal information. Let them run your credit. Show them you have the 20% down and everything like that. If they can't do it, then you want to try and find a private lender. And there's also lenders out there that'll do asset-based loans, but they're going to want to see bank statements too. They're going to want to vet out your personal financials as well as the deal too. I think Bigger Pockets is affiliated with B2R Finance as an advertiser on BP. There's another one called Lima One Capital you can look up. Those are asset-based lenders. But again, they're going to charge you way higher interest rates, and they're going to look at more the deal versus your personal financial situation, but they're still going to want to see bank statements and stuff like that too. So bottom line, Josh, don't worry too much about the bank looking at your bank statements unless you really got something you don't want them to see on there. And if you do, then you're probably going to go with a private lender, get your bank situation in order and get all that cleaned up, and then you can go with a regular bank for a refinance to pull out your private lender in the future. So thank you, Josh. Next question is John. And John is coming at us from, John, where are you from? I thought I saw it. John's from Southern California. Hey, welcome from sunny Southern California. John has an apartment complex, 5-unit apartment complex in Southern California. I'm going to come visit you in Southern California to see your apartment complex just to prove it to myself. And he's got the building was built in the 1960s. Original kitchen, original bath. I've seen many buildings like this that were built a certain way and haven't been improved since then. So it hasn't been touched since the 1960s. If you guys can imagine that, that's what he's got. Appliances updated in the 80s, but his layouts are probably old, cabinets are old, everything like that. Got it. I've determined that he can get, John's determined he can get higher rents if he were to do a turnover, maybe $5,000 in upgrades and make about $200 a month in additional rent. Right? Sounds good. So John pays $5,000 to turn over that apartment, and then he makes $200 a month. $200 a month times 12 months is $2,400 a year. So in 2 years, if the tenants move in and stay in, John gets all of his $5,000 investment back. So that's a pretty good return on investment. That's about the threshold of what I would do to go about 2 years to get a return on investment for laying all cash out to get that back on increased rents. Now, John's facing an interesting circumstance, which is I'm really glad he asked this question. His issue is his tenants aren't moving out. The tenants are probably happy paying a little bit below market rents, and he hasn't had a turnover for a while. He raises the rents 3 to 5% every year, and they're still under market rents, and the tenants aren't moving. The tenants have been in there for 5 years plus, and nobody's moving out for him to create a unit for him to do this turnover on, right? So John, also, you kind of answer your own question here where you say you start talking about how it's not worth getting a tenant out to create a vacancy. I mean, let's assume for conversation you're making $1,000 each unit. In Southern California, that could be half of what you're getting in rent, but who knows? So let's say you're getting $1,000 a month in rent on that apartment. If you force that tenant out, or if you ask them to leave, or if you somehow or another create the vacancy by even offering the tenant some money to get out so you can turn that unit over, you're going to be losing at least $1,000, and that's going to add on to your $5,000 in unit turn, only to make another $200 a month. it sounds like you get a really good situation, John. So well, here's what I would do. I would, if you are cash flowing on the apartment complex right now, if you're cash flowing with tenants paying those below market rents, it's, as long as they're not delinquent on their rents, and if they are, if any tenant goes delinquent, evict immediately, because then you can create that vacancy and do the turn, right? But if the tenants are current and they're paying your 3 to 5% increase per year, which is pretty good, then I'd keep them in there and cash flow the building until the tenants move out, and just quit being so impatient there, wink, and just wait for the building to wait for the 1 or 2 of the units to move out, and then do the turn then. But again, if you're cash flowing, don't quit complaining there, John, and be happy with your cash flowing apartment building you have. So in Southern California, might I remind you. So thank you, John. Thank you, Josh, for your questions to Mentorship Monday, and thank you for emailing helpme@DeRosaGroup.com. For all you other folks out there that have questions, keep them coming, keep them coming. These are great conversations we're having with everybody. So submit to helpme@DeRosaGroup.com. When you have a real estate question, I will answer them right here on Mentorship Monday for you guys. Thank you so much for watching. Have a great and profitable week.